This episode is brought to you by Newline by Fifth Third. Drive your fintech forward with the embedded finance platform designed for enterprise fintech and backed by a leading financial institution. Discover how Newline can transform your business at newline53.com. The FinTech Takes podcast is also brought to you by Paddle. Need more revenue, more growth, and more time? Over 5,000 digital businesses trust Paddle as their merchant of record, or MOR. Unlock more revenue, more growth, and more time. Get more at paddle.com. Okay, well, we have a great show for you today. This is another episode of Not Fintech Investment Advice with my good friend and the author of FinTech Brain Food, Simon Taylor. As we typically do, Simon and I take turns talking about interesting companies in the fintech space that are doing interesting things, and we try to break them down without obviously giving any investment advice, although we do get close a couple of times in this episode. Simon and I have been on a bit of a kick lately as it relates to stablecoins, which is a subject that is very near and dear to Simon's heart, and a subject he has a lot of expertise on. So we have a couple companies in that area. We talk agentic commerce because that is the hottest topic in fintech these days. And, you know, hey, we might want to start a fintech company and raise some money, and agentic commerce is the place to go there. So we talk a little bit about that. And then I surprised Simon with a very small little fintech company that he had never heard of before at the very end of the podcast. So it's a great conversation. We also talk a little bit about an event that Simon is launching coming in November called FinTech NerdCon. So make sure you stick around for a little bit at the end on that, because it truly is going to be an excellent event. I am excited to participate in it. I am also excited to mention to you that the FinTech Takes Network, the professional networking platform that we've built, is just getting ready to roll out. And by the time you listen to this, we will be opening it up to everyone to apply. So if you are a little tired of LinkedIn and Twitter, if you're not quite getting what you thought you were going to get out of various WhatsApp groups or group chats, this might be the answer to the problem that you didn't even realize you had. So would love to have you check that out. We'll be dropping links to that in the newsletter, and I'll be talking a lot more about that on the podcast moving forward. Now I'm going to drop you right into Not Fintech Investment Advice. Okay, Mr. Taylor is here. Simon, good to see you.
Good to see you, my friend. How are you keeping?
I am keeping well. Thank you so much for asking. Busy, lots of stuff going on. In fact, before we get into talking about fintech companies that we're not giving investment advice on, I would love if you could update everyone on what you've been working on, because you've had a big week, sir.
Big week, yeah, and it's all your fault. Accidentally, little bit launched a conference, FinTech NerdCon, by FinTech Nerds for FinTech Nerds. No booths, no sales, but no high meeting agenda. Just 1,000 of the best people in the industry in one place in one time. Not in the Venetian, not in Vegas. And it's your fault because you started talking about the need for this thing when we were in the Venetian and we were in Vegas. And it kind of took on a life of its own. And we already have incredible sponsors. We've had an incredible amount of feedback about being there. And we should definitely do a Not Fintech Investment Advice live in Miami on the 19th and 20th of November. We should do that. We should make it happen.
Simon, I insist that we do that. That must happen. It wouldn't be right if for the very first ever FinTech NerdCon, which is so exciting, if we didn't do a live Not Fintech Investment Advice at the show. I could not be more excited to be participating, speaking, helping to sort of curate a great agenda and set of content. I mean, the conversations we've had so far about who should be there, what should they talk about, it's really not going to be like any other fintech event you've ever been to. I actually haven't been to Miami for a while, so I'm really excited to get back down there, to not be in Vegas. It's going to be incredible.
fintechnerdcon.com to find out more. You can buy tickets, you can get in touch, or you can just cheer us from the sidelines. Pick your adventure. I'm excited for it, my friend.
That is awesome. I am excited too. I am also excited, Mr. Taylor, to chat about fintech companies, as we always do on this podcast. I have a couple of interesting ones that I think are right up your alley, as a matter of fact. But I, being a generous host and you being a wonderful co-host, I would like to give you the opportunity to bring us a fintech company first. So what's your first company?
It won't surprise you it's stablecoin related.
No, that doesn't surprise me.
But I think you might like some of the nerdy details in this one. So this is Ubyx. They are building the Visa for stablecoins. So they're creating a network of merchants, issuers, and acquirers of stablecoins. And they're creating an incentive structure for each participant to add value to the network, as well as a legal framework for stablecoin cash equivalents. So this is the real interesting thing. So people forget that what makes Visa special is like VisaNet. It's like this clearing network of rules where they figure out what money needs to move and then they help you move it. Now, Visa doesn't move the money, the banks often do, but they do the clearing. And that's the critical piece. Well, the launch white paper describes how by ensuring all stablecoins can be redeemed for cash equivalents, stablecoins themselves become IAS 7 cash equivalent from an accounting standpoint. What happens next looks a lot like how participants work with Visa. So you pre-fund a settlement account, you have standardized redemption processes, and a standardized redemption pattern. Wow. I actually missed out on the round. Definitely not investment advice, but I've got to say I was devastated on that one, just because it's so nerdy. Now, that said, I'm curious as to your thoughts, what the moat is here, because they've kind of almost given the IP away in the white paper. And maybe it's that we're so smart we came up with this. But what was holding back a lot of folks from getting into stablecoins was treating it as e-money, treating it as IAS 42 non-cash equivalents. And that meant you had different reserve implications. But if it's cash equivalent, then you potentially get around some of the KYC AML types of challenges that cash has. And so it puts it firmly in the cash accounting bucket, which could make life very interesting indeed.
Well, that is fascinating. You always bring me the greatest stuff, the nerdiest stuff, Simon. I like that one. I think that, anytime anyone talks about Visa and what Visa's superpowers are, I get pretty interested because it is this really powerful settlement network, as you described. I think one question I have that sort of is rattling around in my brain, and maybe you can educate me a little bit on this, is the role of issuers from a stablecoin perspective, right? I've heard this discussed a lot around like, oh, now banks are going to get into issuing stablecoins, or large merchants are going to issue their own stablecoins, or like there can be all of these new issuers of stablecoins. The Visa analogy is interesting to me because I understand from a payment card perspective what the points of competitive differentiation are for issuers and what the points of non-differentiation and cooperation are for payment card issuers, right? And so Visa essentially exists to sort of provide standardization and settlement and a network and ubiquity. And then there's a different layer of competition that all of the different stablecoin issuers compete at. I guess I'm a little bit confused when we think about the stablecoin equivalent to all of this. Where do you see issuers competing with each other versus cooperating through this type of a network? Because obviously, I think there is going to be a need, and you've talked about this, for interoperability of stablecoins. There's going to be a lot of different stablecoins. I want to circle back to the accounting point because that's a really interesting one that I want to double click on for a second. But like, if this is happening and if there are a large number of issuers of stablecoins, how are those issuers competing with each other if it's not based on sort of stability, reserves, ubiquity, use? Like, if that part gets solved by a network, where do the issuers compete?
Yeah, at the moment it's distribution, right? And fundamentally, they are closed loop issuers. that are in a distribution game. So Tether is the offshore choice. Circle is writing partnerships with Binance and Coinbase and everybody else, and Nubank trying to own the distribution. But that gets expensive. I know you had a look at their S1 filing and their prospectus. I did the same thing.
A majority of Circle's revenue went to Coinbase in 2024. That's a lot.
And they've likely done a similar deal with others as well. So the term issuer is fascinating, isn't it? Like,
it is.
Are they a card issuer? Should they be getting some sort of network fee? Should there actually be an incentive structure? Because right now the business model is I issue you, I mint and then issue you this coin, and then I go buy a bunch of treasuries and I monetize the yield off that. Well, if the yield on treasuries does start to go down, it seems to have done the opposite lately.
Right.
But if it did, and if we ever got back to something that resembled normality, well, there goes your revenue. Which is why there's a lot of talk in regulatory circles at the moment and policy circles about making it possible for yield-bearing stablecoins. And maybe that becomes a monetization opportunity. And you start to see that, yes, treasuries back it, but also you can pay some of that yield. And in the DeFi world, the fastest growing stablecoin in history, USDE, is a yield-bearing stablecoin. And so yield-bearing seems like to be one of those major areas they could make money. But now if there's this Cambrian explosion of how do issuers compete, is it distribution? Is it product features? You kind of have a lot of closed loops emerging, and it looks like VisaNet, life before Visa, before the Bank America card became something else, right?
Right, so, before D-Hawk set everybody down and went, this is crazy, we can't do this anymore.
Yeah, so there's a real potential here that the founder of Ubyx is trying to be the D-Hawk of this generation and try and make a cogent, rational argument for a network and build an incentive structure. So to your question, like what's going to be the dynamic? Well, right now we're sort of in a pre-Visa phase.
Right.
So everybody's trying everything. And I need to know what letter of dollar I'm going to send you in order to be able to send it. I need to know what network I'm going to send it on. Like this is janky. And the network thing, Bridge and others try and help and do. But ultimately, in Latin America, they don't call these stable coins. They call them dollar cards. It's a card that gets them access to dollars. So what's the back end of the dollar card look like for the rest of the world? What does the back end of the dollar card look like if it is an upgrade? Some thoughts.
No, it's great. I mean, I totally hear you on the early days of Visa as a point of comparison, right? And I think one of the things that we constantly kind of skip over sometimes because we get excited about what this could be in the future is, Visa only came together as the sort of network that we know today once merchants had adopted credit cards to a point where then the interoperability became such a big pain point that they had to be solved for. So I do think to a degree with stablecoins, it might take a while still for stablecoins to get enough adoption from an end customer and merchant perspective that the interoperability thing becomes a pain point, right? Like right now, it's more of a theoretical pain point, I think, in a lot of cases than it is like a real pain point. But if you fast forward the same way that we saw in the early days of credit cards, you can easily imagine getting to a point where it's like, hey, everybody wants to use this thing. It's getting lots of use. But the pain points of these things they're not interoperable. They're not based on a common standard. There isn't a common incentive structure. That then starts to create a lot of pain and pushes people towards wanting to cooperate. Because, I mean, like the founding of Visa, if you go back and read some of those stories about how D-Hawk pulled all of that together, there is plenty of alternate universes where that never happens, right? Because getting competitive organizations to cooperate on something at that scale, that is like a non-obvious, not easy thing to do. It sort of requires an extraordinary person at an extraordinary moment to sort of fuse that together. And I don't know that we're quite at that point with stablecoins, but I give this company credit for recognizing that we probably will get to that point at some point in time, and needing to definitely have a plan and a structure and a white paper that sort of articulates how you could do that. So I think getting ahead of that makes sense, but we might have to wait a little bit for the pain to build up. Real quickly on the accounting point, this actually came up in a podcast that I did with James Wester, who I know you know at Javelin, and we had a really interesting conversation about stablecoin use cases in a retail payments context. So, sort of setting aside the people in Latin America using it as a place to access dollars.
This was domestic, wasn't it? It was like versus prepaid cards versus the Starbucks rewards card, etc. And the issue of managing the float and how expensive running a prepaid card program can actually be.
That's right, exactly. And the accounting thing was right at the core of that conversation because, prepaid is great. It's a really cool mechanism for being able to do stored value and other things. But the accounting rules are a super pain in the ass, right? Because you have to treat the prepaid balances in a certain way. You can only recognize breakage after a certain number of years. You have to deal with escheatment. Like there's all of these accounting rules that apply to prepaid balances that are kind of annoying. And by contrast, the point James was making that I think is an interesting one is it's too early to say, but if accounting rules end up treating stablecoins differently, if they end up treating them more like a cash equivalent as opposed to prepaid or opposed to something that has these sort of more arcane accounting rules, then the balances held in stablecoins become more generally useful, I think, to anyone who's involved in this network. So your point about changing the accounting treatment definitely clicked in my brain as something I've heard a few other folks in the stablecoin space talk about. And again, might be a little bit too early to know exactly how that's going to look, but I like the idea of people sketching that out.
So it actually goes into quite a bit of detail in the white paper. So an IAS 32 financial instrument is a contract that gives rise to a financial asset and of one entity and a financial liability or equity at another instrument. In other words, it's on a balance sheet somewhere, right?
Sure.
And that creates burdens. It essentially ties up their operating cash, and the way they get around it is by creating a standardized set of rules that apply to all issuers. This is why they insist on pre-funded settlement accounts, standardized redemption processes, and an established redemption pattern. Essentially, that's what allows you to get to the IAS 7 cash equivalent status. And I think this is going to be something that if I'm in a regulator, if I was a legislator, if I was in policy, and I was looking at the Genius Bill or the Stable Act, and I was looking at would you be allowed to have yield versus is it a cash equivalent, I would be paying a lot of attention to this accounting sort of white paper and how it might play a role. Because if we do get that regulatory clarity, then we have the opportunity to potentially have a sort of WhatsApp of money or like an internet of money where we have all of these legacy payment rails, we have all of these things, but we need this sort of layer above it that makes them all interoperable. And if you can solve the accounting and the regulation, you kind of unlock that. And then there's a lot of folks speculating, would that mean more people buy treasuries? All of that could kind of get figured out. But as a pure payments and accounting nerd, there's a real opportunity here, and I think a window of opportunity. So that's why I wanted to bring this one to your attention, sir.
I like it. No, I think it's, again, I like that there are folks who are sketching out what this could look like and what the impacts will be, because I think these problems do sneak up on you, right? Where it's like, oh, stablecoins, this is great. And then suddenly you realize you have a good problem, which is everyone's using stablecoins, but now we don't know how to handle the accounting, or we don't know how to sort of create a common settlement layer. Like there becomes these problems that emerge faster than you might expect. And having some ideas down on paper about how you might handle that makes a ton of sense to me. All right. So Mr. Taylor, I have a stablecoin one for you because I knew you were coming on, and we tend to talk about stablecoins these days on this podcast. And I wanted to get your help in understanding the premise of this one. So my first one is a company called Codex, which has recently raised some money to build a layer 2 blockchain network specifically for stablecoins. And they raised this seed round. They got some participation from Coinbase and from Circle and folks who are deep in this space. And the premise essentially is that general purpose blockchains are not a very good fit for stablecoins because they're inefficient. They're not designed specifically for those use cases. They don't have very predictable fees because they might have sort of volatile activity built on top of them. So Codex is building a specific blockchain on top of a Ethereum level 2 called Optimism. Yep. And it's essentially designed to be sort of the ideal blockchain for stablecoins specifically. And so I think in some ways this is similar to the company we were just talking about in that it does, again, sort of try to address this underlying sort of infrastructure or systemic need around stablecoins. But I'll be honest with you, Simon, I don't think I know enough about this topic to be able to fairly sort of critique or evaluate the premise that stablecoins need their own purpose-built blockchain. Can you help me sort of pull this apart? What's your perspective on this question?
So many thoughts, so little time.
Simon's like he like paused to people who can't see this and just was like, okay, here we go.
Yeah, no, like, look, I guess starting out, there are a lot of blockchains, there are a lot of L1s, there are a lot of L2s, and they are general purpose typically, right? So whether you use Solana or Ethereum or Base, there are some fairly popular ones. They tend to have a similar feature set. I can send and transfer cash, like money, like payments, but typically I can also build a financial asset. I can build sort of a lending contract, or I can represent a picture of a cat. I can do all of these other things with these blockchains. And the argument goes that in doing so, you make them kind of inefficient. You make them hard to work with. You create security vulnerabilities, and that becomes kind of difficult. So what you do by having a general purpose blockchain is you bring down by having a stablecoin focused blockchain is you bring down its costs, you bring down its risk surface area, and you sort of replicate a little bit what we have in financial services. There was always the cash leg of the transaction and the asset leg. So if I was to move money internationally, I typically use SWIFT. And if I was to settle an asset, I do it at the DTCC, the Depository Trust Clearing Corporation. And those live on different ledgers, and they are balanced separately. Now, the argument that the kind of combine the two on the same blockchain crowd would make is what you get from having those both on the same network is this thing called atomic settlement. So if I send you cash instantly, then you would sell me, whether it was shares or stocks or bonds or, widget or a video or whatever it was. You get this atomic settlement. It's there. It's on the same ledger. It's clean. Everybody can see it. But what's happened since then is like, everybody's got their own blockchain, like the Oprah meme of like, you get a blockchain and you get a blockchain. Not only have we got lots of stable coins, we've got lots of blockchains. So now we're building interoperability between all of these blockchains anyway. So if you're in a world where Circle USDC is available, I think on like 20 different networks, why wouldn't it be available on a 21st? And if that one happened to be really good at payments, like a faster horse or a race car for payments, would you expect people to go adopt it? Yes, potentially. But with these things, I remember going through the 2017 cycle and the 2021 cycle and seeing projects raise money. And I kind of got this fatigue of just another blockchain. And now it's interesting that my fintech friends are going through the same thing. It's like, is this just another blockchain? I don't know. Like when Solana launched, it looked like just another blockchain, but now it's kind of a big deal. And then there are so many that have launched that have just completely fallen away. So it's impossible to say. What I will say is Rob Haddock, who's the investor at Dragonfly, who's behind this, really smart guy. deep into stablecoins, has been in that space forever, and is not daft. So keep an eye on this one.
Yeah, no, it certainly seems like it has backers who know what they're doing, and I give credit to the founder who said when this news broke that they sort of moved towards stablecoins as sort of an area they wanted to focus on well before stablecoins became quite as popular as they are now. So a lot of this stuff relates to timing as well. But I think your point about Solana is a really good one, right? I mean, I think it's not as hard to identify, hey, a more purpose-built blockchain for a specific set of activities or just one activity might make sense. I think in the case of Solana, it was really optimized towards speed, right? And making it very, very efficient from a transactional perspective. But the thing that's interesting to me, and this is my outside kind of non-crypto-y viewpoint of a lot of this stuff, but it does seem like what makes these things work or not is the durability of the community that gets drawn to that blockchain and decides that's the place that they're going to build. And it's kind of funny because it's almost like a cultural thing in terms of, and I'll pick on Solana for a second here, meme coins become a thing. Where are we going to build meme coins? Well, let's build a lot of them on Solana. So there becomes kind of a culture, I think, that forms around these different ones. And it seems like the culture that gets formed around it determines both its viability and if it's going to survive or be the one that people use, but also the nature of the things that get built on it, because it's kind of like the internet, right? These little sub communities form around these different places, and it feels like blockchains, their success is largely determined by the community that sort of forms around it and the culture of that community.
It's fair to say, though, DeFi is really big on Solana as well. Base, of course, has done really well. And when Coinbase launched Base, I think a lot of folks thought, what on earth are you launching a decentralized network for? You're a centralized exchange. This makes no sense.
Right.
I do think the temptation is to write this off immediately, and what would seem silly could actually be very smart. There's a feature, I hadn't looked closely at this, but I was just pulling up their website. They have this concept of a liquidity oracle at the heart of their network, and the idea is to make the movement of liquidity across CeFi and DeFi. So from traditional financial services into DeFi. And they connect with 26 crypto exchanges and 225 banks, making it the largest network of its kind in the world. So this is almost positioning themselves as the liquidity hub, the on-off ramp for all kinds of payments, as an anchor, as a differentiator. And I think liquidity begets liquidity. If they've figured that out, that's solving one of the big issues in crypto, which is fragmentation and liquidity fragmentation. There's only so much fun you can have on your own blockchain. If you have to bridge between blockchains to move money around, suddenly you're adding all of this friction. Whereas this liquidity hub is where all of that would start to happen. And what you see, I suspect, is a new market structure emerging where the layer cake will start to build up of these specialist networks. The problem is you risk recreating the maze. We've got such a fragmented market structure, and it's such a maze to try and trade securities or buy things around the world. Are we just going to recreate that maze, or are we actually going to have it instant 24/7 and global, and we're kind of heading in that direction? I hope it's the latter thing, but my God, it's confusing. So I don't blame you.
No, I'm deeply confused about a lot of this stuff, but this conversation has been clarifying. I mean, I think the last point I'll make on this is just, I do think there is this interesting kind of divergence in viewpoints maybe between, hey, stablecoins are one piece of a larger sort of on-chain ecosystem where we can do things that are atomically settled instantly, everything's on-chain, and there's sort of that view of the world. And then there's a different view of the world, which is stablecoins can be a component that is critical to the way that off-chain financial activities and transactions happen. And I think those two different viewpoints kind of color this a bit, because to your point, if you're building a specialized blockchain, it kind of is not really well optimized for that. Everything's going to be on chain. We want to have the most general purpose computing environment for people to transact fully on chain. Whereas the alternative version would be, hey, stablecoins by themselves are going to play a role in this off-chain world. We just need to build a blockchain that's sort of optimized for that. So when you said that they're connecting to lots of banks and trying to sort of be that liquidity hub, that sort of, to me, indicated they might be headed more down the path of like stablecoins being a critical piece of off-chain infrastructure as opposed to the centerpiece of a full on-chain economy. So I do find, again, a common thing in crypto, like different philosophies that tend to color the way these things get built.
And all of them will coexist.
Right.
I think where I stand in all of that is the existing real world bunny ears economy is going to go on chain. And what we're going to see in late 25, early 26 is the beginning of what we consider a lot of traditional TradFi assets going on chain. And you'll see this gradual beginning of a hockey stick of assets coming on chain. And then the question is, when they go on chain, what happens next? What chain do they go on? How do they get traded? There's an interesting point that these guys make, which is the dollar is an important currency, but it's not 99.9% of the world's currency. And part of that needs to be local currencies, local banks need to be able to get on chain. And there's lots of people trying to build around the edges. What they're saying is, this is the solution for that. You could build FX platforms on this. You could build all of that sort of capability over the top of it. So if you were going to have like a dedicated payments rail, they've got a very cogent argument for why you'd need one in the future on-chain economy.
Yeah, no, that makes a lot of sense to me. It'll be fascinating to see how all of that evolves. And also, I know Simon and I are totally aligned on this, how consumer protection evolves as everything moves on chain. But that's probably a whole separate podcast, or maybe it's a rant, Simon, at NerdCon in November. But this, I think, actually is a great time to take a break and pay a couple bills. So we will be right back. Looking to grow your fintech with scalable API-enabled payments? Newline by Fifth Third empowers enterprise companies to accept and process payments seamlessly. Effortlessly launch and scale payment, card, and deposit products directly with Fifth Third Bank. Learn more at newline53.com. Do you need more? More time? More revenue? More growth? Software companies are born global, but the complexity of selling worldwide can be overwhelming. Managing payments, sales tax, fraud, refunds, these things slow you down, but getting them right is essential. That's why over 5,000 digital businesses choose Paddle as their merchant of record, or MOR. More. Complete sales tax compliance globally, multi-currency payments, fraud protection, billing support, all taken care of. With Paddle's MOR model, you get more. More time, more revenue, more growth. Learn more at paddle.com. All right, we are back. And Simon, I can't wait to hear your second company.
So my second company is Agent AV. Think of it as a little bit like Shopify for AI agents.
Okay.
Kinda.
Okay. So
they help agents and merchants manage secure transactions. So instead of like, I don't know if you've used OpenAI's Operator, and it has like a little browser inside a ChatGPT where it'll go to a website, it'll hit checkout, it'll ask you for something and try and log out for you. What Agent AV has is two things. Firstly, merchants get an API that helps agents discover the products and make payments more easily. It's like, come to me, agents. Here's your beautiful API, and you can make a payment. Like I'm just going to make your life easy. Okay. But then on the other side, agents get lots of e-commerce task-like capabilities and the ability to handle complex checkout workflows. So I could sort of see it's like, here's your checkout and here's your inventory. It's not really Shopify, but it's sort of trying to play in that similar sort of space of like, how does commerce work? And it's the stuff around the payment that they're really trying to figure out. And I think it's kind of nice. So look, everyone is trying to figure out agent authentication. Like I can't go into a conversation. I say, what's it going to look like? Tell you, Alex, if we ever get bored of making content, you and I could just go raise money for like agentic commerce. We figured it out, and I swear it would work because it's just insane out there. But whenever it's insane, usually over the 20-year time horizon, it's probably also a really valuable lesson and probably worth looking into. So
totally.
What platform is there that lets you easily sell to AI agents? And how do those AI agents credential themselves? One route is to be the platform that just goes, well, I'll give you both sides of that. So I think this is a good swing. This is a really good swing at it. Like, could be lots of different things. These guys are early, but I like how they articulate it.
Interesting. So you're right. Agentic commerce is like the thing right now. So anyone who's wanting to start a fintech company, but they don't really know what it is, but they just want to raise money and just be a fintech founder, like agentic commerce would probably be the one to aim at this exact moment. I think you put your finger on the button though around the core problem, which is this agent authentication issue, right? And it's kind of fascinating actually because it's a complete inversion of everything that we think we know right now, which is, hey, we need to keep bots out of the spaces that are designed for humans, right? And so every e-commerce website, every ticketing platform, everything is basically designed to try to separate humans from bots and keep bots out. And that's what we built all of our sort of modern e-commerce infrastructure around that idea. And now we are basically flipping that whole thing on its head and saying, actually, humans are going to have bots acting on their behalf. But of course, there's also going to be bots not acting on behalf of humans, but are just like doing bot things. So how do you separate good bots, authenticated bots, from bad bots? So this is like one of the core problems that's trying to be worked out. So I do think the idea of a two-sided approach where you're building both for agents but also for e-commerce merchants, that combination makes a lot of sense to me because I think, again, kind of going back to this whole closed loop, open loop sort of idea, like, I mean, in a strange way, it sort of reminds me of what Plaid is doing in digital identity, where it's like, hey, if you've used the Plaid network before, you can just get an easy pass in the next time that you're working with someone else who works with Plaid, right? And if you can get enough adoption on each side of your little network, you can basically say, hey, if the customer is using an agent that is already gone through our network and that we've authenticated in some fashion, or that meets a set of requirements or standards or APIs that we use, they can just sort of sail through the process and make it easy. If they don't, then they're going to run into this increasing barrier that's going to be erected to try to keep bots out. So I do like that. I think if we were to pull on the Plaid analogy just a little bit more, the question would be, what is the smaller problem that you are solving that is getting people onboarded into your network in the first place, right? Because the value of a two-sided network emerges over time, but only when there's enough participants already doing something else with you that allows you to pull them into this network. And I guess that's the part I'm a little less sure about what that is in an agentic commerce world. One thing that I am curious about, though, with this whole thing is, Simon, what is it that you can do as an e-commerce platform to make it easier for agents to shop with you, right? And the reason I ask this is, and it's kind of like a larger philosophical question, we have these agents that we can train to navigate the way that humans use the internet, right? So like, here's where the checkout is, here's what the cart looks like, here's how you scroll. Like we can do that if we want to. But I often think with AI, how much are we losing, or what efficiencies are we not gaining by building an interface or an API or whatever that's tuned to AI agents, that's tuned to AI rather than tuned to humans that we've then taught AI how to use, right? And the analogy that occurs to me is sort of the difference between surgery tools that are built for a human surgeon versus surgery tools that are built for a robot. Like, if you have robots doing surgery, you can probably give them tools that a human being could never use because they're not that precise or exacting, whereas you can build tools for robots that are better and that create better outcomes. What's the equivalent of that for AI agents in like a commerce setting?
So there's a couple of candidates, and there's a lot of folks trying to do it different ways, right? So Visa, for instance, invested in a company called Payman, that's got a lot of hype around them. And, what they said is, well, we're just going to put our merchants in a box and we're just going to handle the payments. And the merchant doesn't really get to see it. It just looks like a Visa card transaction, and it just checks. So that doesn't solve the problem. Another candidate is Model Context Protocol. I don't know if you've been on the artist formerly known as Twitter recently, but I can't move for somebody explaining what Model Context Protocol is to me. But TLDR, it's do you ever see that movie that scene in the movie The Matrix where suddenly Keanu Reeves knows Kung Fu? It's like, sure. I know Kung Fu. Model Context Protocol is that for AI agents. So I know Stripe's API. I know Notion's API. I know Shopify's API. Bang! I've got all of the docs, all of the detail, everything I need to be really great at dealing with that. There is an argument that says I, as a large merchant, should publish my inventory and checkout as a Model Context Protocol server. Slight issue. Model Context Protocol is very, very leaky and subject to hacks. So, it's not necessarily secure yet, but that's one model that's emerging. But then also, as a merchant, do I want my brand to just disappear? Am I going to fight back against this Model Context Protocol thing? Do I want something else? So Google has announced agent-to-agent authentication, A2A, because we love a confusing acronym. And so they're saying that actually, if you have an agent merchant and somebody, the consumer has a merchant, here's how they can securely talk to each other, not necessarily for commerce, but here's how they can securely talk. We're so early. It feels like the internet 1.0, where HTTPS doesn't really exist yet. Like a lot of the security mechanisms, a lot of what will be normal is all for the taking. It's all up for grabs. So this is one of the big hackathons, that we're going to do at FinTech NerdCon. In fact, we're going to do two. One is what could I do around open banking and Model Context Protocol, to your point. And, there are some interesting open banking companies in the world. And so if I can if my AI agent can securely access my finances, how would they do that? What use cases would become available? And another one is, how do we actually make that authentication secure? So that's what we're doing with the Sardine side is let's just riff on this and let's work together. And I think having a place to try and figure this out with fintech nerds is going to be the only way we move this forward, because everybody's quietly doing it in pockets, but we need to just put a circle around that and get everybody together. So again, this is another example of where it's definitely not you. You're right to say that nobody's figured it out, because the more I look at it, the more that appears to be the case.
Yeah, no, I have the same general reaction to this stuff. It's obviously a lot of people are working on it. And I think the point you raised about what is ultimately good for the merchant is a really good question too, because there is a version of this where it's the commerce enablement platforms connect to agents and allow for agents to very sort of seamlessly and easily find the best products for their customers, but at the expense of merchants' sort of brands seeking into the background and really becoming fungible and just finding the best product, and there being no brand differentiation. And so I do think this idea of what is the agentic commerce equivalent to Shopify, which exists to arm the rebels and enable brands to maintain their relationships with their customers, versus what is the agentic commerce equivalent to Amazon, which sort of kind of pits all sellers against each other in a sort of death match that doesn't allow for any competitive differentiation. The difference between those two different, again, visions of the world will be interesting to see how it plays out in agentic commerce. Simon, can I give you my last company?
Please do. Let's do this.
Okay. All right. So to wrap up, we don't have to spend a ton of time on this one because it's probably not even a company you've ever heard of before, but it's called Experian, Experian. Are you familiar with Experian?
They do. What's it called? Credit something?
Yes, exactly. They are a credit bureau.
That's the word.
And that's the word. Yes, credit bureau. They operate all around the world, including Simon in your backyard. And probably haven't heard of them. They don't make a lot of noise. They're pretty stealthy, but they recently launched a cash flow score, which is what I wanted to talk about with you because it does sort of paint a picture of a future world that I'm pretty intrigued by, which is today we have these multiple different levels that exist from a lending credit decisioning perspective, right? The base level is credit bureaus like Experian that collect all of the data. They're subject to regulations as a credit bureau in terms of how they're supposed to operate. And then on top of that, you build attributes and models and scores and ways of understanding that raw data. And then on top of that, you build decisioning systems that take all of that data and those analytic tools into them, and you use them to manufacture a credit decision if you're a lender, right? So we have these kind of three primary layers of the stack. And what's fascinating to me is Experian in a traditional credit decisioning world kind of has been comfortable operating at all levels of the stack, right? So they are a regulated consumer reporting agency that collects data on consumers. They also provide a lot of analytics. So they have attributes, they have scores. They were one of the primary drivers building the Vantage score, which is a competitor to FICO. And then they also offer a whole bunch of decisioning software that helps you use all of that data and analytics to make decisions. So they sort of live at all three layers of the stack. What was fascinating to me about this cash flow score in an open banking context that Experian has introduced is they describe it using language that makes it sound like they have no interest in being the underlying consumer reporting agency. So they do not want to be the Experian of cash flow data. They want to be the FICO of cash flow data. So they are like consciously moving up from the bottom layer of the stack, and they are saying we are not a CRA as it relates to cash flow data. We are operating on behalf of our customers who bring us the data. We act as a technical service provider to transform that data into a score. We then give that score back. But trust me, I worked at FICO. They are describing their cash flow underwriting solution the same way that FICO talks about the FICO score, which is like, this is just a score. We don't have anything to do with the layers underneath, even though Experian is a credit bureau and could play that role if they wanted to. So the thing I'm curious about, Simon, is how will we see the different layers, those layers I was talking about, get reshuffled in an open banking consumer permissioned data world as opposed to the way that it works in credit bureau land?
Goodness me. I want to ask you that question because like I feel like you're Mr. like credit score, credit underwriting guy. Like I think the first thing actually that I was thinking as you were saying this is like, thank goodness cash flow scores are becoming a thing. Let's just establish that cash flow underwriting is now so unbelievably accepted that the last administration's regulator pushed all financial institutions to go do it, and now they have started to use it from what was like something being pushed away. This has led to increasing financial inclusion, and I think fintech should take the win on that. That's number one. Number two,
I agree.
Creating a score and moving up the stack is a really, really interesting thing to do because, as you have written, FICO is one of the best businesses of all time. It's just the gift that keeps on giving, and that score is baked right into everything. And so they tried it with the Vantage score. It does okay. But why wouldn't you do it with this? And why wouldn't you try and get in front of it when nobody owns that score? Like, I'm curious why FICO hasn't done this. Why it's, they've rolled it into something else. I'm curious if they have a right to win here. I'm curious why Plaid hasn't done this. Like, really, really interesting questions. So actually, I think you're the guy to answer that.
Well, so I'll just really quickly give you my thoughts on this. And this is a topic I'm going to circle back to a lot in future conversations and in my writing. But those are all the exact right questions, right? So when Experian first dipped their toes into consumer permission data, they actually launched with FICO a score called Ultra FICO, which would allow the FICO score to be modified if you added on consumer permission bank account data. So if you have a 720 FICO score and that's not quite good enough, hey, add your bank account data. We'll basically recalculate your score, and if you have a good cash flow history, it might bump your FICO score up from 720 to 750 or whatever. That was introduced, it was a while ago. It was maybe 2019, 2020. I mean, it was a while ago. And what's fascinating about this new announcement is FICO their name is not on any of it, right? So it does suggest to me that while the early experiments with this were more like, hey, can we build a version of the FICO score that takes cash flow data into consideration? And it made sense for Experian to partner with FICO on that. This announcement, FICO had nothing to do with it. They were conspicuously absent. And so that suggests to me that Experian does view building an entirely separate score, right, with the same range, 300 to 850, building an entirely different score that's only based on cash flow data, that there is a viable opportunity to do that I think in some senses they want to take the FICO role in this new world. They don't want to partner with FICO to bring FICO over to this world. Why has FICO not done this? That's probably a longer conversation, but I think largely it relates to the sort of challenge of maintaining an existing business while also trying to spin up a new business. Like those, as we know, just sort of theory of disruption, that's a really hard thing to do. So I think that's probably the core issue. Whereas Experian, I don't think they have any really precious feelings about the Vantage score. Like if they end up killing the Vantage score, it's not like it ever was a huge business for them anyway. So they're probably okay with that. And then to your point, there are going to be other providers that are trying to do this, right? So I'd say Prism Data is probably the one that's furthest along in this cash flow world. They have a cash flow score. It's on, I think, like version 3 now. So it's a pretty mature score. And what's interesting is Prism is trying to get as many of the providers in this ecosystem to basically not build a competitive score, but to partner with them instead. And so they have partnerships with Equifax. They have a partnership with LexisNexis. I'm sure they would have loved to have had a partnership with Experian before they launched this score. So they are, in some senses, they have a partnership with Plaid. So they are trying to get as many of the providers in this space to say, hey, you guys go do other things. We'll do the scoring piece. And Experian, I think, is the first example I've seen of an incumbent in the credit scoring world who said, actually, no, we would like to build our own thing here rather than partnering. And so we are starting to see a bit more of a competitive dynamic as opposed to a collaborative dynamic in cash flow scoring.
They got the right name. It's the cash flow score. I know exactly what it does. It's kind of self-descriptive. And I hope it takes off. I really do. Shout out to those guys.
I do too. It'll be fascinating to watch. Yeah, the plucky upstart Experian. We're rooting for you. All right, so Mr. Taylor, I don't know if there's anything in the last minute or two that you want to manifest. Selfishly, I just want to manifest a really great NerdCon in November. I'm really looking forward to that. Can we just settle on that, since this was launch week, and I know you've put your heart and soul into this event, and I am very, very happy for you and very excited to participate.
No, thank you. So you took the words right off the tip of my tongue. I'm manifesting making it to November, making it through November, and frankly, being around all of my fintech friends. This is the event by fintech nerds for fintech nerds. FintechNerdCon.com. I would love it if people check it out.
All right. Well, that is a great place to end. Simon will be back at it next month, but until then, thank you, sir.
Stay classy.
Thank you for listening to this episode of FinTech Takes. Stay up to date with emerging companies and the latest FinTech trends by subscribing wherever you get your podcasts. And if you love FinTech Takes, please tell a friend.